Okay, so about macroeconomics, what I do is I just track the monetary policy of the United States, and they do behave on a cyclical way. So they have periods where they're just printing money and deploying capital into businesses and to people as well. And that just boosts economy on an artificial way. And then you have periods where they do the opposite. They don't print any money and they raise interest rates, which essentially makes pressure to everyone holding debt to actually pay more over time. So what that does is it just forces the economy to drag down and slow down, which has been happening for the past, I think it was 2 years. They were just raising interest rates. Now, the way I see it, and there's multiple narratives around this, but to be very honest, the way I see this is when they're printing money to give to economy in general, they're just doing that as much as possible till it stops to actually create any positive effect on the economy. So when they print, the companies just get more money, people spend more, and they do that till it doesn't keep doing the effect of boosting economy. So when economy is slowing down in terms of going up, they just reverse the policy. They apply narratives to the circumstances, such as inflation, to reverse the policy. But to be honest, I think those narratives are just a way to justify to the public. I think they intend to create as much economic swing as possible, as much dynamic as possible. Because how people make money is by investing. But if the investments stop going up, no one has interest in let the money there. So rather just reverse the policy and make pressure on the economy to actually go down and people take their money off their investments, because no one wants the money to be there stuck when you're not earning anything, right? So they just reverse. You should sell on that moment. And then by the time they reverse, they just apply as much pressure for the economy to go down as possible. They actually make bankruptcies happening with this method, and also some people struggle with their debts. But when economy stops going down, or in this case, because elections was and are approaching in the United States, they reverse the policy so that by the time the elections happen, economy has to be on a good state. So the idea is for people to be happy on that moment, to raise the chances of re-election happening. So what controls the money supply is the Fed, and they say it's independent from the government on the United States, which is obviously not the case. Everything is connected in some way. That's why there's people on the government positions, some people related to the government, that they have access to some information that allows them to either invest or sell off certain companies. But the idea of the system, I honestly don't see the system same way most people do. They see the system as a bad thing. I think the system is just conceived for people to make money as long as they understand the system. So meaning that as long as you invest, you make money. Just by working, you don't really get richer. But you can get extremely rich without earning a lot of money from your work, thanks to the way economy operates. So yeah, there's multiple arguments around if this method is good or not. A lot of people are actually against the method, even people that obviously understand the method and benefits from it. I think that people that are truly interested on understanding how the machine works can just make profits of it. Of course, that you have to learn a lot of stuff, which is not what you will learn in school. But information is out there. People can actually learn it. But yeah, I don't attach either good or bad to the system. That I do the same on most things because I think it's about a perception. Of course, that for people that just work and don't invest, they cannot really get wealthy, and that's unfortunate, but there's a way out, right? So many people that did very well because they learn how the system works, and people that were very poor. So I don't think this is something attached to any issue related to the system itself. Because the way I see it is like, you can get a lot of money if you understand how to operate. But if the system was not implemented this way, that would mean that probably you had no way to actually get off this 9-to-5 for life job or for 40 years. But yeah, I understand both perspectives. I'm not actually either pro or against the system. I just understand there's good things and bad things, like in most things that just is out there. But essentially, the policy has been reversed. They started to lower interest rates, and the money printers already started to turn on. So they are artificially making the economy to go prosper again. So the next 2 years, you cannot say a fixed rate because this is variable, but I would say likely to be at least 2 years. There's people saying you will have a bull market till 2030. But yeah, what matters is the policy. So as long as they turn on the printers and they lower interest rates, people will have more money on the pocket, companies will get richer, investments will be going up. So in the next 2 years should be very good for people that are investing. Meaning that in growth terms, you want to invest now and sell off in 2 years, okay? But this depends because, for example, I have companies where I'm invested in. Their value may or may not go up the same way as Nasdaq, for example. What this means is like policy can be on a good state, but your investment can be just stuck at more or less one price without going up too much. But then it can just spike off like 3 months out of nowhere, just spikes up, shoots up. Especially on startups, the way the price increases tends to be like this. Takes a short term, like months of going up, but then just starts to fall. So you can have a swing that spike the price, but in the space of like 6 months, 1 year, the price just comes back down. So it's situational depending on what people are invested on. And yeah, there was an interesting experiment around some people. Because most people lose money on the markets due to the fact that people have an emotional attachment to their money. So when they invest, they tend to fear to lose the money, meaning that if the market goes against them and they lose a certain amount, they are more worried about losing everything than properly earn something from the investment. So people tend to sell off when they are on a certain amount of loss. And this is attached to the risk tolerance as well. So people with low risk tolerance cannot really stay on the markets on a loss of like 30% or something like this. So yeah, startups is a tricky space for people that don't have risk tolerance, because there you have to understand that what matters is the fundamentals. You can be on a huge loss, but as long as your investment is fundamentally good, you should just wait and stick to it. Because as you may understand, if you read a lot of people's stories, there's people that, like, till they understood how the market operates, they were having a good win on the money, and then they start to lose money. They just stick to the investment or average down. The strategy can be variable. But what matters is that they didn't sell. The companies didn't went bankrupt as well. So on the next bull run, it shoots up again, and then they understand they should just sell. So yeah, a lot of people learn this way, which is a hard one, meaning you literally start by investing to something, you see that thing shooting up, and then you never sell, it comes back down, you're on a loss now, and then the next bull run you're like, okay, this time I'll know better. Yeah, a lot of people, I see the history just goes like this, meaning that the first cycle, economic cycle that they actually get it right, they only learn that they should be selling. Because media, what they do is on the bull run, when you should look to sell on a certain amount of gains, that is variable depending on the space you're investing as well. It's not a fixed one, never, like no one knows exactly a number. But the media just says that everything's good, everything is like wonderful. And that's kind of your line to consider to sell. Because when they come to the public telling these things, they just want to drag more liquidity. So the investment funds and the people that already invested on a long time ago, they are just looking to sell on that moment, more or less like this. So yeah, better way to operate is to look to sell on the bull market, look to buy on the bear market. That's a simple strategy that I take. All right, guys, gotta go now, and see you later. Bye.